got Dave Maney joining us, the Expert Press CEO, Victoria Fernandez, a Crossmark Global Investments Chief Market Strategist. Guys, thank you for joining us. Victoria, since I begin with you on what you want to hear from Jerome Powell.
Well, I'm not sure it matters too much what I want to hear. I think what we're going to hear, Neil, is that they're going to remain hawkish. I don't think that Powell is going to pivot at all. I think people that are anticipating him to be a little bit more dovish will probably be disappointed. You heard the comments from Esther George. There have been other Fed speakers out, and everyone is talking about remaining vigilant and continuing to raise rates and continuing to fight the inflation. We heard the comments about that stickier form of inflation that is still around. I think there could be a bigger surprise. If there's going to be a surprise, it's probably going to be that he is more dovish than what people are anticipating. If we get that, I think you see Treasury yields come down and you might see a small rally in the equity market. But I don't think the perception is going to be dovish. I think it's going to be towing the line that they've been doing for the last couple weeks.
I always wonder, too, Dave, if Victoria's right on that. I mean, how the market would react to that. It would essentially mean we're not, really changing anything here. It's just finessing it. What do you think the markets would do?
Man, Neil, this is a unique moment that I can kind of recall in which the signals are conflicting so much. Right. And it's kind of like, is it that one set of signals about whether we're in this, staying in this inflationary spiral is wrong versus this kind of economic slowdown, fear? I've never seen a time when so many things you could make such a good argument in either direction. And so, I have to think that the market's not going to be a whole lot more definitive than the Fed chair himself. Although I do wonder if he takes a hike, does that mean he's going to press for a hike?
To that point, it's interesting, Victoria, because when you're raising the possibility of maybe a half-point hike next month, and the markets, I don't know where they stand right now, expectations of a three-quarter-point hike, but there was a consensus building around, especially given the strong data that we've been seeing, including the strong consumer spending in the latest GDP read of the second quarter, that maybe they would stick with that three-quarter-point hike, the third such hike in a row. So I'm wondering if it's not that, whether there might be hell to pay.
Yeah, I think a lot of it's going to come down to the labor report that you were referencing earlier, to the additional inflation reports that we're going to get. But look, if you look at Fed Fund futures, back at the June meeting, we were at that high, Fed Fund futures getting around 375, 380. We saw that come down after the July inflation reports, but now we're right back up to where we were in June. So I think the market is expecting to have some higher rates, whether it's 50 or 75 in the long run. I don't think it's going to matter. It's where the neutral rate is. And if they want to move the neutral rate or move Fed funds rate higher than inflation in order to be restrictive and get that inflation component coming down, they still have a ways to go. So if it's 50 instead of 75 this time, then I just think that means for the November meeting or for the December meeting, it's an extra 25 basis points built in at that time.
So net, it would still be the overall number of increases, which would take us to 3.5, possibly higher by the end of the year.
Right.
Dave, I'm curious what the 10-year bond is telling us right now. It's comfortably over 3%, so you could interpret from that the markets are already sensing that economic activity will still be strong enough to warrant these hikes. But what do you think?
I think that's right. I am beginning to feel that we're entering a time where, it's like that saying about things where people have one extreme view or another.
Oops, we had a problem there. On that point then, Victoria, let's say Jerome Powell surprises us, and given the strength that we saw in the slightly improved second quarter GDP report, and the fact that so many retailers, even though they're having a problem, it's not nearly as much as a problem as we thought. In fact, some of them are doing very well and giving very promising guidance, that he might just say, I can't take my foot off the pedal here, and I don't intend to.
Yeah, I mean, I think that's probably where he's going to lean a little bit because, you know, the credibility of the Fed is a huge issue. You saw them lose some of that credibility over the last few months. They want to get that back. They want to stick to their idea that they are going to fight inflation at all costs. They've already told us they're willing to risk recession. They're willing to have weakness in the labor market. So I don't see them pulling back. I think they're going to continue to keep their foot on the gas. Again, whether that's 50 or 75, I don't think makes a huge difference. But you do have corporate bond spreads actually narrowing right now, which to me says the bond market is pretty comfortable with this outlook of where they're going to be. If we have a huge change from one to the other, we'll probably see some ramifications there, more volatility. That just means investors have to look at strategies that can capture volatility and be well prepared for that.
Usually a sign of everyone being in sync when you see a development like that. Victoria, thank you. Dave, Maney, thank you. Sorry about some of the technical problems we had with Dave. It had nothing to do with Dave.